Everyone is absolutely obsessing over the silicon. The prevailing narrative over the last 2 years has been entirely focused on graphics processing units, advanced packaging, and securing enough chip allocation to train the next frontier model. But if you look closely at the physical infrastructure, the real constraint on the AI boom is not the silicon itself. It is the electricity required to turn those chips on. Welcome back to the Working Thesis. Today, we're launching a brand new series called The AI Power Chain.
It is great to be back, Maya, and you hit the nail on the head. We are looking at a striking fact that completely reframes the AI infrastructure race. According to broad industry estimates and analyst consensus, nearly half of the U.S. data centers that were planned to come online in 2026 are currently facing delays or outright cancellations. And crucially, this is not happening because developers cannot find enough chips, and it is certainly not because they lack the capital to build. They are pausing because they simply cannot secure the electricity to run them.
That is a staggering realization. The entire technology sector is moving at the speed of software, projecting exponential curves for intelligence and compute. But at the very bottom of that stack, you hit the hard reality of the physical world. If you cannot plug the facility into a reliable, massive source of power, the most advanced semiconductors in the world are essentially just very expensive paperweights.
Exactly. And that disconnect between the speed of software and the speed of heavy industrial infrastructure is where the real story is. This series is going to serve as a field guide to the companies that actually solve that problem. We're going to explore the businesses that build the electrical equipment, move the high voltage current, cool the scorching hot server racks, and generate the baseload fuel required to keep the modern AI economy running.
So while the broader market continues to hyper-focus on the semiconductor designers and the massive cloud platforms, we are going to look one layer deeper. We are going to map out the entire power value chain, starting from the grid down to the cooling pipes on the servers. Let us look at why power is the true bottleneck and how we're going to navigate it.
One small thing up front. We genuinely love these companies as stories, but we're explaining them, not recommending them.
So treat all of this as food for your own thinking, not financial advice. Stay curious, stay a little skeptical, and make your own calls.
To really understand the scale of this bottleneck, we need to put some hard numbers on it. Let us look at the projections for 2026. Industry analysts expect that there should be roughly 12 gigawatts of new U.S. data center capacity coming online that year to meet the surging demand from AI training and inference. To give that context, a single gigawatt is roughly the output of a large nuclear reactor, enough to power a medium-sized city.
12 gigawatts is a monumental amount of newly required energy in a very short time frame. But the reality on the ground tells a very different story. Out of that projected 12 gigawatts of expected demand, current tracking shows that only about a third of that capacity is actually under active construction today.
Right? That leaves us looking at a looming power gap on the order of 7 gigawatts. The demand for that compute is very real, backed by massive corporate budgets and fierce competitive pressure among the tech giants. But the physical supply of electrons simply cannot keep up with the pace at which these companies want to deploy capital.
And that 7 gigawatt gap represents hundreds of billions of dollars of stranded potential. When developers map out their timelines, they're realizing that buying the land and ordering the computing hardware is actually the easy part. The bottleneck is literally the grid connection. You have massive facilities ready to be built, but the local utility is telling them they cannot provide the required megawatts for years.
It forces a complete rethinking of how digital infrastructure is deployed. We are no longer in an era where you can just build a data center anywhere and assume the local grid will happily absorb it. The availability of power is now the primary dictating factor for where, when, and how artificial intelligence physically scales in the real world.
That naturally leads to the most important question. Why can't the supply just scale up to meet the demand? If there is this much money on the table, why isn't the physical infrastructure expanding faster? The answer is that the physical world operates on a fundamentally different clock than the software world.
It is a painful reality check for the tech industry. Let us look at a prime example. High voltage transformers. These are the massive, house-sized pieces of equipment required to step down grid power so a data center can actually use it. Right now, A large transformer takes 2 to 3 years to procure. We are talking about lead times of 128 weeks or more just to get the equipment delivered to the site.
And the delays compound from there. A new, large-scale grid connection for a hyperscale facility can easily take up to 5 years to get fully permitted, engineered, and energized. If you need to build major new transmission lines to bring power from a distant generation source to the data center, you are looking at the better part of a decade.
Compare that to the data center itself. You can construct the actual shell of the building and outfit the interior in about 1 to 2 years. But because the interconnection queues across the country have ballooned to unprecedented lengths, the building sits idle waiting for the grid. That lead time gap, the difference between a 2-year build and a 5-year wait for power, is the defining constraint of the AI era.
But here is the critical takeaway for our map. For the developers, that lead time is a massive headache. But for the industrial companies that actually manufacture this heavily backlogged gear, that lead time is a formidable moat. When your production capacity is sold out for the next 3 years, you have incredible pricing power and revenue visibility. That backlog is the foundation of the investment theme we are tracking.
To gain confidence that this isn't just a temporary narrative or a passing fad, you look for massive, independent pools of capital moving in the exact same direction. And right now, we are seeing the convergence of 2 completely unrelated megatrends. First, you have big tech, Alphabet, Microsoft, Amazon, and Meta.
The scale of their spending is almost difficult to comprehend. Based on current consensus estimates, those 4 companies alone are on track to spend roughly $650 billion on AI infrastructure in the year 2026 alone. They are in an existential race to build frontier models, and they view infrastructure spending as table stakes for survival.
Separately, entirely disconnected from the AI race, you have the U.S. electric utilities. The American grid is aging, and utilities are being forced to upgrade infrastructure that is often 50 years old, while also managing the transition to renewable energy. Because of this, utilities are set to invest more than $1.1 trillion into the grid over the next 5 years.
So you have the buyers of the compute flooring the accelerator to build massive new facilities, and the builders of the grid flooring the accelerator to modernize the electrical backbone. Both of these massive capital cycles demand the exact same physical inputs: switchgear, transformers, cables, and turbines.
Exactly. When hundreds of billions from big tech and over $1 trillion from regulated utilities are competing for the same finite manufacturing capacity, you get a secular trend that is incredibly durable. The demand isn't reliant on a single company or a single new product launch. It is driven by a structural, multi-year overhaul of how the country generates and consumes power.
This brings us to the spine of our entire series, which is how we actually navigate this space. When you look at the power value chain, the market treats the 2 halves of this equation very differently. The companies that make the equipment, build the grid, and cool the servers are currently trading near their historical highs.
The market extends a lot of trust to those companies. Because of that massive lead time moat we discussed, and because they sell their hardware to every data center builder regardless of which tech giant ultimately wins the AI race, their revenue streams are highly visible and relatively de-risked. They are the classic pick-and-shovel play.
But then you have the other half of the chain, the generation companies, specifically the merchant power producers, who actually generate the electricity and sell it into the market. These companies trade deep below their historical highs. The market applies a heavy discount to them because they carry significant risks that the equipment makers do not.
Right, the merchant producers face power price volatility and the long-term risk of an overbuilt cycle. If the market becomes oversupplied with power a decade from now, their margins collapse. So, in shorthand, the market's current posture is clear. It would rather buy the shovels, the equipment and cooling makers, than rent the miners, the merchant power producers.
That contrast in market sentiment is the exact map we will follow throughout this series. We are going to walk through the highly trusted, premium-valued equipment layers first, and then step down into the heavily discounted, higher-risk generation and raw materials layers to see where the true physical bottlenecks lie.
Let us start walking that map, beginning with Layer 1, the trusted, near-highs layer of equipment manufacturers. A prime example here is GE Vernova. They sit at a unique intersection because they manufacture the massive gas turbines that actually generate the power. And they also build the electrification grid gear required to move that power across the country.
They are arguably the most direct industrial beneficiary of this entire theme, sitting on a huge, highly visible backlog of orders. Then you have companies like Eaton, which serves as the North American electrical backbone. If you walk into a major facility, Eaton provides the critical switchgear and power management systems that keep the lights on and the servers running smoothly.
Eaton is also expanding aggressively into data center cooling, bridging the gap between moving electricity and managing the resulting thermal load. And underneath them, you have Hubbell, which is essentially the pick and shovel inside the pick and shovel. They make the unglamorous, highly standardized hardware that the grid relies on.
Exactly. We're talking about utility-grade connectors, specialized switchgear, and rugged enclosures. It is not flashy, but the physical grid literally cannot expand or modernize without these components. Because these parts are so essential and heavily specified, Hubbell enjoys a quiet, incredibly durable market position.
These three companies represent the foundation of the equipment layer. Because they are so central to the structural bottlenecks we discussed earlier, we are going to dedicate full, standalone deep dive episodes to GE Vernova, Eaton, and Hubbell next, breaking down exactly how their businesses operate.
Once that electrical equipment successfully delivers power to the facility, the physics of the data center immediately transforms that massive electrical draw into an equally massive amount of heat. That brings us to layer 2 of our map, cooling.
The thermal density of modern AI racks is staggering. We have reached a physical threshold where traditional air cooling simply cannot move heat away from the chips fast enough. Pushing cold air through the aisles is no longer sufficient. Liquid cooling has transitioned from an optional luxury to a strict engineering mandate.
You have to bring specialized fluids directly to the chip to manage these loads. And the pure play standard in this space, the company acting as the cooling toll booth of the AI factory, is Vertiv. They have built an incredibly dominant position by managing the thermal reality of these high-density workloads.
They are the critical link between the electrical input and the computational output. Now, we have actually already done a full, comprehensive, standalone deep dive on Vertiv. We spent an entire episode breaking down their technology, their moat, and their financials.
That is right. You will find that complete Vertiv episode already published and waiting for you right here in this playlist. Because we have already covered them in depth, we just wanted to place them clearly on this value chain map today to show how cooling bridges the gap between power delivery and generation. And then we will keep moving down the chain.
That brings us to the other half of the chain, layer 3, generation. Ultimately, all of this equipment is useless if someone does not actually generate the electricity and sell it into the grid. This is where we shift from selling the shovels to renting the miners.
A key player to watch here is NRG Energy. They are a massive merchant power producer, also known as an independent power producer, or IPP. They operate heavily in the Texas ERCOT market and are actively signing data center power deals as hyperscale demand absolutely explodes in that region.
But it is crucial to understand that generation is a fundamentally different business than equipment manufacturing. A merchant producer does not enjoy a steady backlog of fixed-price hardware sales. They live and die on fluctuating wholesale power prices. That structural difference is the defining characteristic of this layer.
It brings a much higher potential reward if power prices remain elevated due to chronic shortages, but it also carries the heavy, looming risk of an eventual overbuild re-rating. If the region brings too much generation online, the price of their core product crashes.
That is exactly why the broader market trusts the generation layer less, and why these companies trade well off their historical highs compared to the equipment makers. It is a more volatile, high-torque way to play the power constraint theme, requiring a very different kind of risk appetite.
Finally, we hit the absolute bedrock of the value chain, layer 4. This is the physical fuel and the raw metal that sits underneath everything else. Before you can generate power or build a transformer, you have to extract the required elements from the earth.
When you look at the sheer scale of the 24/7, uninterrupted baseload power required by AI data centers, nuclear energy is increasingly recognized as the only viable clean answer. But you simply cannot run a nuclear reactor without specialized fuel, and the West is structurally short of it. That brings a company like Cameco into sharp focus.
Cameco is one of the premier uranium producers in the Western world. As tech giants actively look to nuclear to solve their baseload problems, securing the raw uranium required to fabricate that fuel becomes a critical geopolitical and economic choke point.
Alongside the fuel, you have the conductive metal that wires the entire planet, copper. We will be looking at Freeport-McMoRan, a global copper giant. The physical reality of the AI infrastructure build-out is that it requires an enormous, unprecedented volume of copper.
It is inescapable. Every high-voltage transformer, every mile of transmission cable, every industrial motor, and every server rack inside the data center is heavily wound with copper. These raw commodities are the fundamental inputs that every single layer above them completely relies upon to function.
So, how do we actually surface these specific companies out of the thousands of stocks in the market? Briefly, each of these names first showed up on our radar through a technical stock screen. They were flagged by a specific chart pattern, like a stock emerging cleanly into a fresh uptrend, or bouncing from a deeply oversold turning low.
But we have to be completely honest about this process. A chart pattern alone, in isolation, is remarkably close to a coin flip. The pattern is just the very first filter to get our attention. We never rely on the chart to tell the whole story, because price action without fundamental backing is incredibly fragile.
Exactly. We only zoom in and commit to a deep dive on a name when the valuation makes sense. The underlying macro thesis is a massive tailwind, and we can identify a real, measurable turn in the actual underlying business. The chart gets them on the table, but the fundamentals keep them there.
We actually break down that exact methodology, how we build the radar, how we run the screens, and how we combine technicals with fundamentals in a separate, dedicated explainer episode. You can look for it on the channel. For this series, just know that these companies cleared a very strict fundamental and technical bar to make the list.
As we move forward, we want to set clear expectations for what this series will deliver. Every company deep dive we do will follow the exact same 4 beats. First, we explain why the initial screen flagged it. Second, we explain why this specific company cleared our fundamental bar.
Third, we break down the business itself, what they actually do, the strength of their moat, their key customers and competitors, and their core financials. And finally, we look at where the stock has historically found technical support and resistance, alongside a simple framework for whether it looks cheap, fair, or rich today.
But here's the crucial framing you have to keep in mind. Those support and resistance levels are fluid. They move over time as the market digests new information, and what you choose to do with that data is entirely your call. We are here to map the terrain, not to drive your car.
And we have to highlight the honest caveats. The massive infrastructure build-out could easily turn into an overbuild cycle. Merchant producers can re-rate violently to the downside if power prices collapse. And commodity names like copper and uranium are notoriously cyclical and genuinely hard to value.
Leadership changes, quarterly numbers miss expectations, and macroeconomic conditions shift. We are presenting a highly disciplined map of the AI power chain, but it is not a money printer. Nothing we discuss in this series is investment advice. It is an educational framework to help you understand physical bottlenecks.
So here is the journey we are taking together. From this overview, we are going to dive straight into the equipment layer first. We will start with GE Vernova, then move to Eaton, and then Hubbell. From there, we map the cooling layer, and again, you will find that Vertiv deep dive already waiting for you in the playlist.
After we cover the highly trusted shovels, we will step out onto the riskier curve. We will explore the generation layer with NRG Energy, and finally dig down into the raw fuel and metal with Cameco and Freeport-McMoRan. It is a complete path from the grid connection down to the mine.
The goal is simple. Understand why the market is rushing to buy the shovels and accurately assess the risks of renting the miners. Next up on the channel, we are launching right into GE Vernova, the undisputed equipment king of the power transition.
Until then, please do your own research. Everything we share here is designed to be a starting point for your own analysis, never financial advice. Thank you for joining us to map the AI power chain. We will see you in the next episode.
That's a wrap for today. Thanks for thinking it through with us. We're just testing our theses out loud, one day at a time.
Catch you on the next one. Stay curious and tell us where we're wrong.